Well, welcome to a new video from Economic Perspectives. My name is Peter Warburton. I'm Director of the company. I want to speak today about the prospects for a new generation of monetary policy coming from the central banks. And many of you will say, well, surely we're coming to the end of unconventional policy, that the Fed is reducing the pace of its monthly purchases, and indeed around the world other central banks are poised to begin a new cycle of tightening. Recently New Zealand stepped out, raised its policy rate by 0.25%. We have Norway thinking that it might do the same. We have Malaysia, Bank Negara, possibly also considering its first move. So why should we need to think about a next generation of monetary policy? Well, obviously we need to focus in this issue really on the US Federal Reserve and where we stand with regard to the development of the economy there and its central bank. Recently we had a couple of speeches which both in their way were I think quite revealing and significant. On the 21st of March we had a speech from Jeremy Stein who spoke very eloquently about the financial stability risks that there are to pursuing a purely expansionary monetary policy. And he pointed to various contexts where credit may already be kind of getting out of control and starting to pose some of these threats. But on the 31st of March we had new chair Janet Yellen speaking in a very different way and in a very different context to what she feels still needs to be done to tighten the US labour market and to move away from a narrow focus on the unemployment rate and towards a broader array of measures of labour market tightness. Where we come out of this, and particularly in the light of Jeremy Stein's unexpected resignation that came just a few days ago, is that we have the Fed really expecting the economy to strengthen, expecting the labour market to strengthen, and expecting there to be no shocks that would disturb its current policy course. I think that's a very unlikely scenario. I think the likelihood is that as the Federal Reserve moves away from its monthly purchase program and edges towards the start of its interest rate rising program, that there will be a number of hiccups along the way. What we've seen repeatedly is that the shorter dated part of the US Treasury market has been ratcheting up. So the curve has been flattening, but flattening from the short end as nervousness approaches of what people indeed have come to believe is an imminent tightening cycle. The related question that we must ask is really whether the equity market is at all protected as this tightening cycle approaches. My answer is that I don't think we can be at all certain that there is a strong commitment on the part of the US Federal Reserve since the departure of Chairman Bernanke of Fed intervention to support the confidence of the equity market. So let's just suppose now that we see this challenge emerge over the course of the next few weeks, perhaps some stronger economic data propels US bond yields higher, but at the same time unnerves the equity market. We have to ask then, what will the Fed do? How would the Fed respond to what it might see as a premature move in the Treasury market, as indeed it experienced last year, and paused its program, its expected tightening program then. I think we'll see not just the US central bank but other central banks reaching again for other tools to try and maintain an easier stance for longer. So what might these new tools be? It could of course be just a resumption of the large-scale asset purchases. It could be another tweaking and recalibration of forward guidance, but it may be that this is the time when asset purchases are redirected away from the Treasury market towards private sector assets. Interestingly, we have a parallel context in Europe, where the European Central Bank has again felt the need to introduce a new element in its recent policy pronouncements, with open admission of a discussion about a new form of quantitative easing. We're left to speculate what the content of that program might be, but we are presuming that it's likely to be focused on bank debt rather than on government securities. However, both in the US and the Eurozone, I think the message is clear that if required, there will be another level of response, another invention of response from the central banks, and that we should not assume that central banks are out of ammunition or out of ideas.